Hello everyone, it is that time again, month 20, time to buy a stock.
20 months in and we are still going through a boring spreadsheet and not using fancy apps.
It's how we roll.
It's how we roll, old school. We have on this list, we went through our spreadsheet, and out of the 15, 16 stocks that we looked at, some of them are viewer requests. Some of you guys have said, hey, what do you think of this company? And other ones on the list are just because, well, we think it would be nice to look at those companies.
We have two of them from Punished Jess.
So
we put it on the spreadsheet just for you.
And we did go through the numbers off screen. We looked at the company in depth. And if you would like us to do an in-depth of those individual stocks, or if you're not this guy and you want us to look at companies on your own, comment below and we will look at the companies for you. Boy, it's quite the time in the market. The Fed said they might be done. The stocks went way up, and then they did a head fake, and then they said, well, we're not sure we're going to be done yet. And then the stocks went right back down. Where we stand in the market right now is we still feel that we want to see positive earnings per share numbers. We want to see the housing market reset a little bit. Right now, interest rates are crazy. We just did a video on that. And we would also like to see the Fed say, without the head fake, that they are actually done.
Done.
Like the battle has been won. Then we're going to get positive. We are still waiting, and good Lord, it's taking forever. But until it's done, we're still going to wait.
Thank you, Jerome Powell.
Yes. All right, so first stock on our roasting list. So we had about 20 companies that we looked in the list. Overall, the originally list was like 50 companies, narrowed it down to 20, and then now we've got what is amounted to 6 companies on this list. The first one is Annaly Capital, and we're gonna start roasting some of these because Annaly Capital, I personally have shares in. I've had them for a very long time. And back in the day, there was some conflict, this is about 10 years ago, where, hey, they're issuing more shares. They keep diluting the value of the shares that you have by issuing more shares. And guess what happened? 10 years later, they're still doing that. And it drives me crazy. If you're trying to look for principal growth on your stock, you can't dilute because then your stock goes flat or it goes down. And in Annaly Capital, they got walloped. And it's not just because the housing market is having problems. It's because they keep diluting their shares. For that reason, we're not buying them this month, but we are still looking at REITs because we know that there's going to be some opportunity there. It's just not quite there yet.
We'll let you know when.
Very frustrating, but we will let you know for sure. Which brings us to the next one, and this is quite the Cinderella falling from grace story.
Poor Lumen Technologies.
So there's a long story here. We can get into it a little bit more if you guys want to hear about it, but Lumen Technologies was the telecom darling of the 80s who got pretty big and now are pretty small.
They were a huge company.
I have a huge company.
Back in the 80s and 90s, during the dot-com bubble, they fell from grace. Hard.
There was a lawsuit that happened that they were talking about this new infrastructure for 5G, and they were trying to build this new fiber backbone network, and they were promising investors that, hey, this is gonna be great. And come to find out, right before the stock just took an absolute nosedive, well, we're not really as far as we said we were. In fact, we're just kind of getting started. And by now, at that point, the investors had poured billions of dollars into this company, and they just took a nosedive.
And you could see from 2014, they've just been on a downward slide for 9 years, and they went from $40 a share down to $1.15. So it's a huge hit.
Huge problem.
We are waiting for them to see what happens when they go through their second restructuring and how they facilitate that, and to see what positive earnings per share, if they can come up with that. I mean, a lot of people move their money out, but if they can recover from this, they might be a good buy if somebody doesn't buy them out. So for the reason of risk, and just for the reason of just looking at the telecom industry in whole, we looked at them and wow.
Terrible.
Wow.
Shame on you and Lumen.
It's really sad because of my personal portfolio, I've only lost money on 3 stocks, and this is one of them. And I've had them for, I mean, their dividends have paid me for over a decade. So I've made the money back in dividends, but that principal value, it's like,
And again, haven't really lost the money until you sell it.
Yep, so we're also looking at it for that reason, but this is a cautionary tale. We said this before, and I've told you we've had hard lessons. If a company pays a large dividend, we had just somebody commented on our PBR video and they says, well, they're going to pay a 15 to 20% dividend. That is a red flag. That is not a positive thing when they take that percentage of their earnings and can't invest it back into the growth of their company.
Right. That's huge. Unless they're just making trillions of dollars a year and they have no idea how to spend all that money.
Yep, and Lumen was one of those companies that was paying a huge dividend. So there's your warning.
Sorry, Lumen.
So they're out. Next one we have is a company called AHT. This is the viewer request.
This is Ashford Hospitality.
Yes, and if you want us to get into what the heck happened to them, because they're almost as bad as Lumen.
And this is one that Punished Us wanted us to look at.
Yeah, so long story short on these guys, they used to be trading at like $1,000 per share.
And not that long ago. We're talking what? 2015.
Yeah, and they are $2 a share.
They fell hard.
Harder than Lumen.
They crashed down to earth. Like, I want to know what happened to these guys, because we've done some of the research with the numbers and found them lacking, but
and that's why we're not buying them for this month. But we could do a deeper dive if you'd like us.
We haven't figured out why. I mean, these guys are a trust, and it looks like hospitality management for hotels and stuff like that, real estate REIT type thing. But man, what happened? We know that 2020 happened. We know that COVID killed some of the economy, and the hospitality people weren't traveling as much as they were, but that's more than there's something else there.
If you want us to get into depths with that, when we buy our monthly stock purchase, we first look at the finances, then we look at the news, and we look at everything that's going on. This one was so bad that it was like, well, we're not going to get into the news. If you want us to do that, please comment. We will do a separate video on these guys. But for now, holy crap.
So sorry to punish us. I don't know what you're seeing in this long-term play, but yeah, we are completely out. And I don't suggest anybody to go into it unless they do a lot of research to figure out why.
You need to know what's going on with this business behind the scenes, because their numbers look just as bad as this next one. This next company was also a recommendation from a viewer, and they
Punished us.
Another Punish you very. So this is a Ryzen Holdings, and this company is a
enigma.
It's an enigma. Ryzen Holdings, stock symbol QRNNF. How do you come up with that symbol? They are basically an OTC company. This is called a pink slip company. So the difference between a regular company and a pink slip company is pink slip companies, you usually need special permissions to purchase. This one though, when we normally look at companies that are small like this, we're out just for the size of the company. However, the finances of this business did not look awful. So we're not positive, but we're not negative about this one, in the fact that in the industry that they're in, and with the bank balance, their assets are showing that they're going up, their liabilities are relatively, I mean, they're not going up as much,
right.
And that they show a gross revenue increase over that same period of time are actually kind of positive things. So the size of the company though, very volatile. When they're this small, they're very volatile. So before we would decide that, hey, we want to put this in Dividend Dude's portfolio, we really want to dig into this one a little bit more. So if you want to see that in depth, we can cover this one specifically for that too. The problem though, also because it's an OTC stock, you're not going to get a lot unless you actually pull the actual financials from their I-9s. So there's a little bit more digging with these companies, but for the size and the scope of the business for the Dividend Dudes portfolio, we're out for that reason.
They do have a 6% dividend according to Schwab. It's nice and all if they're making money, but there are other better companies that can give you a 6% dividend that I'd much rather go with at this point until we figure out what's going on with this company.
Yep, so on the flip side, there's much less risk to the bigger companies, but the bigger companies aren't going to grow as fast as, say, something like this does. Right. I do know the logistics and transportation industry, they're a cyclical industry, and they're kind of coming off the bottom of that right now, assuming there's no World War III. Hope there's not. In that realm, it's on fire lately. Where there was no availability of freight and shipping back during COVID, like they couldn't get the trucks, they couldn't get the ships. Now there's too many of them. Now there's people fighting over the same shipping freight. So it's way all over the place. And in order for us to feel safe about it, we want our investment not to be manic depressive one day and excited the following.
Right. And I really think Punished Justice is really looking at the stock price on this, that because both of these are like $2 and the barrier of entry is pretty low. You could throw a lot of money in and get a lot of shares, and this one's 6% dividends where you could get good quarterly dividend from that. But we need to make sure that one, it's going to consistently pay that, and their model is going to actually grow. And I think you're looking at, okay, $2, this has a potential of growing. And if it goes up to $10, I'm making a lot of money on my investment and getting the dividends. So I could see what you're looking at. But
if it goes up,
you need to look more into the company to make sure that it is going to do those things.
So if you want a deep dive, we'll do it. But for the scope of a safe investment for the portfolio for all of everyone watching, we are out for that specific reason of not just the OTC size of the company, but because the metrics of freight, shipping, and it's just, that's such a small business comparatively to what you could invest in for the same amount of dividend and growth potential without the risk involved. This is a very risky play.
You guys love your shipping companies.
They really do. And our AITs.
Right, because in general they pay a lot, right?
They say they
pay a lot.
That doesn't mean you actually get paid.
The allure is there, so I could see how they went. Maybe we'll do a whole shipping video just on shipping companies.
Another one? Oh.
Well, we did it on Zim, but we could do it on the whole shipping industry as a whole.
Here's the boats, here's the products, they go on the boats.
Comment below if you want to see that.
We can do that.
All right, so
what did we buy?
What did we buy? Ooh, we bought two.
We bought two.
We split it.
We are accelerating the portfolio to make the YouTube channel more enticing so that people are excited to get investing with us and their own financial advisors. But we bought this month two stocks. Coca-Cola was the first stock that we bought. Kimberly-Clark was the second stock that we bought. Let's get into why. Coca-Cola and Kimberly-Clark have, in fact, if you looked at our spreadsheet, Coca-Cola actually looks very good as far as their financial goes. Kimberly-Clark, from our last purchase, their financial numbers haven't changed. So they're still the same as they were in our monthly purchase video from there. We're still waiting on that report to come out. Both of those numbers looked very good. In fact, Coca-Cola was very close to the top, and both companies are trading at their 52-week lows. In Kimberly-Clark's case, the 52-week low back when COVID was happening.
And we like a beat-up stock. We keep beating that one forward.
Yep. And once again, with the portfolio, we want to try to keep it defensive with the dividend checks so that we have a consistent, solid base to build from, and then we'll start buying some maybe more of these more risky freight companies.
Right. Coke and Pepsi are dividend kings, so Coke is always a very good one to get into, and especially if it's down. I mean, you don't want to buy it at the top, but when it's down, it's a good time to buy.
Especially because you get your cost basis for a dividend check is lower.
Right.
So you get more dividend for the same amount of money.
Exactly.
And we asked somebody earlier today, it's like, well, if you invested $10,000 and you got, like our portfolio invested value right now is $14,000 and you got what, we're getting like $50 a month in dividends?
56, I think.
Yeah, people are like, oh, that's not exciting. Not right now. But dividends themselves, if you talk just the dividends, not the stock appreciation, those go up between 9 and 12% every year if you buy a stable company. So what is only $600 for our portfolio this year is over $4,000 every year before you even get to year 20. And that's just the dividends. The stock itself will go up, and you can look at most of the dividends in our portfolio and see what has happened to those over the past 20 years, and you can even look at the companies themselves to see what the value of the stock has. So I know this is not necessarily crazy exciting compared to most of the stuff you see on YouTube, but it will make you money.
Right.
It just takes time.
And yes, we're buying dividend dynasties and kings, but it's when you buy them. That's the key.
Mm-hmm. And how long you hold them.
And that $4,000 is assuming you don't touch it ever. But if you keep putting money into it and dollar cost averaging, and every month you find that low stock and you put it into it, and that grows quickly.
And you'll see that. We've got in our portfolio, every month we buy that, you'll see the value. You can see what's happening with that. So there's value to you to stay tuned.
Yep. So what our portfolio looks like today isn't bad.
No, we've done quite well.
We've done quite well. I think it's down 2%,
Especially compared to my professionally managed 401k.
which is down 15%.
Come on, guys, you do it for a living. Anyways, thank you for watching. We hope to see you in the next video.